Hey there, everyone. Happy Thursday and welcome to the Final Bar. It's Thursday, August 1st. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com, coming to you from a warm and sunny Las Vegas, Nevada. Hope you guys are all doing well. We're having a great time here so far at the Money Show. Going to be speaking tomorrow and again on Saturday, so having a great time getting to meet some of the attendees. Again, any of you that are attending, please make sure you say hello, and please make sure you attend my presentations. I'll be speaking, Friday afternoon, 1:15 p.m. Pacific. We'll be doing a live recording of this show. Tomorrow I'll be talking to Mary Ellen McGonigal. We'll get her take on this choppy environment, elevated volatility, the great rotation of 2024, the political situation with the election season heating up, and all of the above, what stocks we should be looking at given all of those expectations. Then Saturday morning, 2-hour masterclass from 8 to 10 a.m. So grab some coffee and meet me there. But please make sure you say hello. Always a pleasure to meet some viewers here at the Money Show. So today, as we get to our market recap, you're going to see a lot more red. Interesting today, though, the macro backdrop, right? So we obviously have a lot of earnings to talk about. We had Meta yesterday, which ended up being a decent outcome. Tomorrow, or actually today after the close, we have Amazon, Apple, Intel, Coinbase, others as well. But when we think about this environment, this is one of those times, first time in quite some time, that negative economic data has actually been taken as a negative sign for stocks. So far in 2024, we've been thinking the opposite, right? Bad economic news is good for stocks because it implies that the Fed's actions by keeping rates elevated are having their intended effect of slowing down the economy, bringing inflation in check. Good economic data would be bad because that would mean either the Fed is impotent and their actions have not been enough, or not soon enough, or not thorough enough, or just that the economy is still overheating and inflation is going to be a problem, which would imply potentially further rate hikes down the road. So what's interesting today is bad economic data or negative economic data, which should be a great sign for stocks, implying that first rate cut is coming. On the other side is actually causing stocks to go down in a big way. And it certainly seems like elevated concerns about recession seem to be top of mind, right? So if bad economic data is bad, that means investors all of a sudden are starting to be concerned maybe that the actions of the Fed to date, while bringing inflation in check, are going to be too much and actually causing maybe a recessionary period. Now, to be clear, if you look back over time, if your runway is long enough, recessions actually tend to be great for stocks, but in the short term, it can cause some pain. With that in mind, let's chart how the pain actually played out. The S&P 500 finishing just below 54.47. That's down 1.4% from Wednesday's close. The Nasdaq Composite down 2.3%. Mid caps, small caps, all down over 2%. The S&P 600 small cap index down 2.7%. Look at the waterfall decline that happened this morning, really into the lunchtime hour. From then on, it was sort of slow and steady, but the damage had been done. The VIX popping up to 18.6. Midday, it got up to 19.5. We almost got above 20, which is a key level that I pay attention to because it's usually a sign that a pullback may be turning into a deeper corrective move. Didn't play out completely that way. The VIX finished today around 18.5. Still up a full 2 VIX points from yesterday, which is around 16.5. Now we're up to 18.5. Just in 1 day's trading. So certainly a big day for volatility. I would say recognizing the volatility that certainly seems to be pretty widely accepted for equity traders here. Interest rates overall continue to move lower. You can see the 10-year yield firmly now below 4%. Yesterday, we were around 4.10. Today, we're finishing the day around 3.97, so just slightly below that 4% level for the first time since January or February, I believe. 5-year, 30-year points all moving lower. The long bond ETF, the TLT, was up about 0.9%. The dollar up about 1/3%. The dollar really hasn't gotten into danger areas yet. I would point you out, those of you that follow Larry Williams' work and follow his premium content on Stockcharts.com. It is very, very well done. Larry is a legendary trader and educator and continuing to drop some serious market knowledge on all of us talked about how, over the longer term, the dollar is very much tied to inflation. So as inflation's coming down, risks of a strong dollar here are pretty low when you look at the historical relationship. Commodities all in the red here on our dashboard. The DBC down about 1.1%. Gold, silver down slightly as well. Crude oil prices moving lower. Energy just beaten out by technology as the worst performer today. Bitcoin actually having a bit of a bid through the course of the trading day today. So sort of an interesting contrarian signal to what we saw with stocks. Stocks moving down through the course of the day. Bitcoin actually showing some signs of life here. Currently trading just below 65,000, and that's after coming off over the last couple weeks after failing an attempt to get above 70,000. I'm wondering if we'll be able to certainly get back above that level. But for now, 65,000, sort of that short-term level of resistance. All the other of the top 10 coins that we follow on our platform in the red today. Looking at the 11 S&P sectors, you can see utilities and real estate, the two defensive sectors, or I would argue most defensive sectors at the top of the list. Utilities up 1.9%, real estate up 1.6%. So think about what that means as our major benchmarks are down 1.5% to 2.5% today. Utility stocks were up almost 2%. REITs were up over 1.5%. Healthcare, consumer staples, both up about 1% as well. So the defensive areas of the market actually doing quite well, not just outperforming on a big down day, they're actually flat out going up. Technology down 3.7% today. Energy, second from the bottom, down 2.6%. Consumer discretionary down 2.4%. This great rotation continues, as I mentioned. Tomorrow on the show, we'll have Mary Ellen McGonigal. We'll talk to her about this rotation and where opportunities may be in her perspective, given all of this rotation. But I think that it is a reality. We'd speculated about a rotation away from mega cap growth into other things. It's happening. A day like today is exactly what that looks like when those rotational elements come to fruition. Looking at the Magnificent Seven stocks, you can see Meta having a nice up day after beating earnings yesterday. Nice bright spot today, up 4.8%. It was up in the aftermarket after reporting yesterday. Continuing to move higher through the course of the day today, finishing up almost 5%. All the other Mag 7 names were down, and most painfully, NVIDIA back down almost 7%. This is after yesterday's nice recovery day. Last 3 days have been big moves. NVIDIA is worse than Bitcoin in terms of its daily percentage swings all of a sudden. Tesla down about 6.5% as well. All right, let's look at the damage in the form of the S&P 500 chart. When you look here, you can see that really, I would argue that a day like today in some ways kind of confirms the breakdown of trendline resistance. This pink trendline is one we've been talking about for quite some time. You can see the October low, the April and May lows lining up pretty well with where we've been the last couple weeks. The gap lower last week pushed us below the trend line for the first time. We tested the 50-day moving average. And as of today, just like 2 days ago on Tuesday session, we closed almost exactly at the 50-day moving average. We traded intraday almost down to 5,400. So we are back sort of in that limbo between trendline support, which has been broken, the 50-day moving average, which technically is still holding because we haven't had a follow through below that level, and then the 5,400 level, that gap from June continuing to hold here even today. So tomorrow going into next week, my question is, does 5,400 hold? Now, we have some earnings which could provide a decent catalyst to move higher, but for now, certainly feeling as weakness is the story of the day. S&P below 5,400, while not the end of the world, to me, opens the door to further downside objectives. That's where I would be sharpening my pencil, and we will be talking immediately about some downside objectives if there is a confirmed breakdown below that point. All right, let's look at small caps here. I just want to look at the equity market indexes, and we'll look at the IWM here. Small caps, of course, coming off today. I just want to point out the fact that, while small caps have been a very compelling place, certainly in the month of July, you've seen small caps kind of come under their own. And this is after breaking out of this coil pattern earlier in July. First trading day in August, sort of giving back all of those gains that we logged here earlier this month, right? Not all the way down to the July starting point, but certainly almost half the way down, it feels like. So, today, quite a distribution day across the board for many things, except, again, for some of those defensive areas of the market. But small caps getting hurt along with large caps as well. It's worth noting here, we do have a bit of a divergence with higher highs in the course of July with lower momentum, and maybe that's part of this concern. I think the structure of small caps overall is still okay, but we are testing the lower end of the range that we experienced in the last couple of weeks. So keep an eye on that short-term support around 215. I think breaking that, the IWM, really, we're looking at the 50-day moving average, a return to this range, this equilibrium range that we spent quite some time in from April, May, June into early July. All right, let's go to the VIX, and I just want to point out how the VIX has popped right back up. Yesterday, the VIX kind of came off a little bit, and it felt like maybe we were getting to, maybe that spike in the VIX was being alleviated, but there's a couple times we've had this where a big push higher, and then again, sort of returning a little bit further. This is the highest the VIX has been really since the April pullback, right? As the S&P went from around 5250 down to 5,000 before bouncing up to the July peak. We saw the VIX spike up to not quite 20, but sort of in the 18, 19 range. That's kind of right where we're at right now. So on that pullback, this was really the end of that move. I'm curious if we get above 20. Again, it could be the end of the move as it was in October of 23, but big declines have almost always, if not always, been marked in modern market history with the VIX pushing above 20. That's why it's a level I pay attention to. VIX above 20, it means we're in a corrective move. And the question is just how deep, how long, how protracted that decline is. And we turn into trend followers on the downside. We look for signs of accumulation that downtrend is over. And what happened after the October 23 low, after the April 24 low, is you had signs of accumulation. You started to put in a higher low, started to show some upswings, showing demand coming back in the market. But for now, VIX nearing that danger level of 20. I want to look very quickly at two sector charts here. We look a lot at the relative strength of the 11 S&P sectors. I just want to focus your attention on the bottom series here. We'll look at the last 1 year just to highlight how in the month of July, technology has gone from, certainly been one of the best performers coming off of the April market low to all of a sudden leading the way lower, underperforming the market in July and not by a little bit, but by quite a lot. Look at that relative line versus utilities, which is trending higher. So when we talk about the great rotation, I think one of the great ways to illustrate that using the relative strength, you really want to supercharge it. Use the RRG and look at the rotation away from growth and into defensive sectors. It is magnified. Let me go there next. Shout out to Julius de Kempener, of course, creator of this methodology. You can see it certainly a bit on the weekly, but I think on the daily especially, you're going to see it just absolutely magnified. Right, so here are your growthy sectors. Here's consumer discretionary, here's technology, here's communication services. Out of the three, communication services starting to improve a little bit. But the relative strength is really defined by the x-axis. The furthest to the right, that means the more it's outperforming using this daily time frame. Look at how everything else, all the value sectors, all the defensive sectors are in the leading quadrant. All the Magnificent Seven sectors are not. That is what has happened here in the month of July. I'm curious if that continues to happen here in August. If so, particularly if the defensive sectors like utilities continue to show strength, it just is not the type of environment that feels like a recovery, that feels like more decline to be had as long as utilities continue to outperform, because that suggests that institutions are getting more and more defensive. We'll finish off here looking at some individual names. Shout out to Meta with a decent earnings win. Now, after hours, the stock was up, opened higher, of course. Well, opened just above 520, traded up around 525 plus, but by the end of the day, traded all the way back down to 498, 490, just below that, around 497.75. So you can see we did finish up 4.8%. But on a gap day, once you have that opening gap, I think it's important to see what happens afterwards, right? If this is a really bullish gap higher, if this is a nice earnings win that has legs going higher, has momentum to be had beyond this, then you'd expect buyers to be buying that breakout, right? The gap higher, investors are thrilled, they're optimistic, so they continue to buy. Then we're talking at the end of the day of breaking above the peaks for 2024, making a new high for the year, and talking about how we might need to see follow through on Friday into the beginning of next week. We did not get that. The higher open was actually sold through the course of the day. Meta actually traded lower through the course of the trading day, end of the day, we got back down to the 50-day moving average. This is not a stock breaking out. This is a stock gapping higher, but traders are selling that strength. They're thrilled to cash out at 520. They're like, great, let me get out and get defensive again, buy utilities or something. That's kind of what happened through the course of the trading day today. So nice gap higher, but not a great look through the end of the day. FMC is another one. I'm going to look at the zoom in on the candle chart. Actually, I'm going to bring in a little more data just to show that, maybe even a little more, maybe 6 months of data here. So this is what FMC Corp has looked like. And FMC, if we're not familiar with it, I was going to say specialty chemicals, I thought was the group here. You see how we gapped up to resistance from May and from March and from January? It's right around $65 a share. We opened here, we traded above that level, but by the close, we're right back below that level of resistance. Here's the zoom in on the last 6 months. You can see the peaks in May and in March. We can see the open, the higher trade all the way up to 68.50 or so, but then we're closing back around 64. This is another one of those Pinocchio candles that Martin Pring has talked about in some of his articles recently. Pinocchio candle, something like a shooting star, but not just a shooting star or a hammer at the lows, but it actually trades through a key level, a long-term resistance level. So in this case, we open low, we trade higher, but by the close, we're back below it. That's a shooting star candle. It's also, he would call it a Pinocchio candle because it's basically the longer the nose, the more of a liar Pinocchio is. We traded above that level, but it was sold off when we rallied up to that point. So investors were thrilled to cash out from FMC above $68 a share. That propels the stock back down. Indicates or implies weakness over the next 1 to 3 bars. So the stocks that did trade higher, some of them certainly did okay, but a lot of them I'm seeing, like what we saw with Meta, higher open, lower close, something like FMC, which also gapped, but ended up being a shooting star candle. Some of the things that traded lower on earnings today, Crocs, a bit of the opposite, right? It gapped lower, but traded higher. So it did close down about 2.7%. But I like the fact that we closed near the highs of the day. That actually showed that investors are buying in on weakness. It actually traded down to the April low, just a hair's breadth away from the 200-day moving average before closing back above 130. I actually think that's an encouraging sign for Crocs that it's able to hold that support. If I'm holding Crocs here and I still own it, I would have a big horizontal line. I would set an alert around 120. I think this is a decent chart above there. Below there, you have to see the likelihood of a retest of the 2023 lows, at least a further decline below support. If that can't hold, if the 200-day can't hold, why hold that name, right? And this is after bouncing off of an oversold condition here recently. Sirius XM Holdings is another one that is traded up to the 200-day moving average a number of times in the month of July. Every one of those tests has failed. This last week, we have yet another retest and failure. It's down another 6% today, currently trading around 320. So this is now technically a low price stock. But I have to point out the fact that failed attempts to get above the 200-day ROI, it's often great to wait until you have a valid break above the 200-day moving average, because otherwise, a lot of times it's just noise below that long-term barometer. Eaton Corp, kind of a classic industrial company. And this one is not a shocker kind of day. We actually opened lower but traded higher. So you're finding some tactical support in that 285 to 290 range. Overall, I'm not encouraged by the fact that we have gone from higher highs to lower highs, higher lows to lower lows, above an upward sloping 50-day to below a downward sloping 50-day. We're still above the 200-day moving average, which is kind of where we bottomed out in October 23. But the momentum overall more bearish than bullish. And certainly the stock is underperforming because other things like utilities and REITs are doing fine while the Eaton Corps are rotating lower. So I think a lot to not like in that chart until you see signs of accumulation. ConocoPhillips, one of the big integrated stocks. You have Exxon, Chevron, and then ConocoPhillips, kind of that next tier down. Still a large cap name, but not of the size of those first two. Look at the range we've been in. We're actually testing the lower end of this range. It really has been in play for the last 12 months almost, right around 107 to 110. We're kind of right back on that level again. I'm concerned that most recently we traded up to the 200-day moving average. The RSI stalled out around 60. That's the sign of a stock not able to get enough upside momentum. I think a concerning development right about there. terms of names reporting after the close today, let's get through a couple of these. We're going to go to the symbol summary report. We'll bring up Amazon first. And again, I've not looked at the headlines, just looking at the after hours trading. So bit of a bearish engulfing pattern today for Amazon, trading up to moving average resistance. That's the 50-day and the 20-day moving average. We opened higher but closed lower, gapping down after hours, currently trading around 174, which actually takes us to really a new monthly low, and actually getting down to that May-June low here around there, and that's in line with some of these previous support levels as well. So negative reactions so far to Amazon. Let's look at Apple, which is another mega cap name, down about 2% after the close, still around the 50-day moving average. It looks like around 214, we'll call it. So still kind of holding there, not too far below where we've been in the month of July, but selling off a bit going into the close. This is the danger, I would argue, if they do open lower tomorrow. The danger for this market, if these mega cap names can't beat on earnings, and a Meta, even having decent earnings, can't propel things higher, can't push these other names higher in sympathy. It's not a good sign for our benchmarks, which are really driven by these mega cap names. Let's look at Intel. Down big in the aftermarket. I saw that they missed earnings. It's down big time, down another $5. It's almost 19% after the close. This is down about 5.5% during the trading day today. We're currently trading around 23, 24, which is way below the viewable area. That's a new 52-week low for Intel, assuming we open down around that range tomorrow. That's not a great sign for, one of the semiconductors that really diverges quite a lot from others, but certainly one to watch. Finally, Coinbase, and this is not a huge name. It's certainly a topical name, obviously with a big play on the crypto space. What's interesting about Coinbase, it's been range bound here for the last couple months, right? Really the last 6 months, from 200 on the lower end, around 275 on the upper end. We've been in this range, currently trading around 218. Now it's bouncing up a little bit from today's weaker close. I'm wondering if that is the sign of a bounce off of support and maybe a swing trade back to retest resistance around 260. We'll see how things open tomorrow. But for now, one of the few companies out of this larger list that I'm looking at showing some strong movements in the after hours. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. And again, hope to see some of you at my Money Show presentations on Friday and Saturday. Please make sure you say hello. For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good one.